Let me bring on board two experts. Swash Chaudhary, Head of Fixed Income Group with the IDFC, and along with him we've got Arvind Nairaman. He's Executive Director and Head of Sales and Treasury with DBS. Gentlemen, good morning. Thank you for joining us. Arvind, let me kickstart the discussion with you. What do you make of the intervention from regulators? Sebi and Reserve Bank of India, they both are trying to desperately stem the free fall in rupee.
Yeah, hi, morning. The measures came as a bit of a surprise, what we saw from the Reserve Bank and Sebi late last night, but it made a lot of sense because the idea seems to be to weed out speculators and bring out actual hedging intent into the market. This has had the desired impact. We all know the volumes on the currency side, on the currency future side, is dominated by a lot of speculative intent. As soon as these announcements came post-market hours yesterday, the offshore markets had already corrected, and the Indian market this morning has also reflected. To my mind, this is a good move. It's a short-term move. Ultimately, the domestic buying would come in. There is genuine demand for dollars, so dollar rupee would continue to go up again. In the medium term, the market would look at something more than just these measures to decide if the rupee has to go up or down. But right now, the trend still looks to be dollar rupee going higher.
So Yash, hi, morning. We've seen a breach of 61 yesterday and then came in the Sebi to arrest the fall. Where do you see the currency stabilizing in the near term?
To my mind, the intent now from the...
So Yash, the question was for you.
Okay. We have definitely entered a zone where there seems to be more regulatory action. So if you look at on an RER basis, it's often quoted that the rupee is fair valued now. You see a lot of media headlines as to both, structural measures getting accelerated as well as these shorter term measures like curbing speculative action. However, I would broadly agree that the path of the rupee seems to be weaker given the context of an ongoing global portfolio rebalancing in favor of the US and the fact that some of our structural problems, some of our supply bottlenecks that are leading to high current account deficit will take time to solve. So I would think unless a larger announcement effect is engineered via something like an NRE bond, etc., my bias would be to expect a weaker rupee.
Arvind, let's look at the big picture. The crack in gold is great news, but the fall or the appreciation in crude clearly will nullify the impact of crack in gold. Also, in the second half of this financial year, the food security bill will be implemented. Growth is unlikely to make a comeback, and at a time when money is moving out of emerging markets, there is a big question mark on foreign inflows. So if I look at the macro environment, looks like rupee is nowhere close to its bottom.
I completely agree with you. You've nailed it on the head. Most of the factors which you've listed down are exactly the factors which are playing on investors' minds. And most of us are wondering what would it take for the rupee to start strengthening and maintain that trend. Fundamentally, dollar rupee needs to go higher, so that's by and large given. What we need to see is definitely intent on the structural reform side. And when I say intent, it doesn't just mean announcements. Markets would probably be looking for actual policy actions and actual money coming in, because we've seen a lot of announcements in the past, but that hasn't been followed up by money coming in. But we must remember that liquidity is finding its own market. So India is no longer the favored destination. So even if announcements are being made, let's say on the FDI side, the proof lies in when the money comes in and what size of money comes in. Until then, I guess macro fundamentals would determine a weaker rupee.
So Yash, we all know that the US economy is on a gradual mend. Does that mean that emerging market currency devaluation is something which is going to be an ongoing problem the Reserve Bank will have to grapple with?
I wouldn't say that, rupee depreciation is necessarily a problem. The pace of the depreciation is a problem because it has not given time for balance sheets to adjust. But fundamentally, if you are a high inflation, high current account deficit country, then it's hard for you to argue for a stronger currency. In fact, if anything, the stronger currency will impede the structural adjustments that need to be followed through. So I would think, that approach policy should take is, instead of trying to artificially engineer a stronger rupee, just to stabilize, put it on an orderly depreciation path, and in the meanwhile try and help balance sheets the best they can. But yes, if broadly the view of QE tapering is intact and it's a near-term view, I would think high current account deficit countries will be hard put to having a stronger currency.
Arvind, the 10-year yield as well has jumped to a 3-month high. When do you see that stabilizing?
Well, to my mind, it also looks to be a bit of an overreaction on the US yield side. While there's no doubt that the US economy is recovering, QE tapering is possibly on its way, and interest rates have to go up in the US, the kind of announcements and the kind of movements that you've seen on the yields are similar to what you see on FX actually most of the days. So to my mind, market is a bit surprised, does not know what to expect in terms of a QE tapering, and hence yields are reflecting this kind of a move. To my mind, yields should stabilize a bit lower for now, and market would wait for more serious direction before taking dollar rates higher. The current move looks a bit exaggerated to me.
Right, Arvind, so very quickly before we let you go, last question really, do you think the RBI has any elbow room to cut rates in the coming policy, or should we gear up for another status quo?
I don't think a rate cut is figuring on their minds right now at all, so I guess we need to keep that out for now. Even the swap rates, if you notice, are not pricing in any rate cuts for the next 3 to 4 quarters. So to my mind, rate cuts seem to be out of the window for now.
I know you have a packed day ahead. Really appreciate your time, and I know you're running in between meetings, so thank you for joining us. Suresh, would urge you to stay back because I've got some more questions for you. Suresh, to your mind, are bond markets pricing in a rate hike, or rate hike is something what bond markets are not pricing in? I mean, the rate cut talk is out. Now, the question is, when will rates move up?
Well, I wouldn't exactly agree that rate cuts are totally priced out, because if you look at the term premia on our curve, the overnight is at 7.25, and if you look at the new 10-year benchmark, it's roughly hovering in the 7.5 vicinity. Now, given the kind of supply that the bond market will be called upon to absorb in the months of July and August in the near term and then over the second half, it's fair to expect that 7.5 should not be the level if at some point in the future the bond market was still not hopeful for a rate cut. So yes, over the next 2 or 3 months, bond markets have priced out a rate cut. The swap markets are pricing it out entirely, that's true. But the government bond curve still is hopeful that, later in the year possibly there will be a rate cut. Definitely no one is talking about a rate hike, it's not in the price. Neither, for the record, would we expect any sort of a rate hike.
Suresh, but do you think the center of gravity clearly is just one thing? It is US bond yields. And depending on the way how US bond yields will move, emerging market debt will move, emerging market currencies will move, and it is the US bond yields which will dictate or decide how money will move in the second half of this year for all emerging markets?
I would actually make a nuance there. US bond yields may actually stabilize after a while. If you look at real yields over there, they are quite attractive. Secondly, if the broad view is that dollar is appreciating, most foreign investors or local investors for that matter should be happy owners of dollar assets. And US bonds is a dollar asset. So at some juncture you may find that US bond yields stop going up, but possibly the dollar continues to strengthen. And that is really the linkage that would worry me more, that the dollar continues to strengthen and hence the rupee continues to depreciate, and a consequent impact or rub-off on emerging market assets per se. So that's really the distinction I would make between the US Treasury and the US dollar.
Okay, so Yash, good chatting with you. Really appreciate you taking the time out and joining us today on ET Now.